Yesterday, I gave an extremely simple analysis, and after the single trigger that I gave got triggered, exactly what I said would likely happen has happened to this point less than 24 hours later. Yeah, you nailed it this time, but do you ever go over your calls when you're dead wrong? Yes, Donor Joe, indeed I do. And the reason I review calls after I'm right or wrong is so that we can all learn from the experience. So in this particular case, my analysis was extremely simple. And the unfortunate thing is, I don't know if you could find that exact type of analysis anywhere else on crypto Twitter or crypto YouTube. So what we're going to do is we're going to review what I said yesterday. We're going to see how it played out, and we're going to soak that in so the next time this situation happens, we're prepared for it. And then I'm going to give you a little bit more potential bad news on lower end targets, which align with what I've been saying for the last 3 weeks. Bitcoin's in a 30K range between 30K and 60K. $30,000 Bitcoin, unfortunately, is still in play, particularly given our analyses on the monthly and the quarterly closing and the shapes of the candles. So although this is setting up to be a red month, January, in this video, I'm going to give you the exact triggers when we know with a close to probability that that won't be true. So we can then flip our bias. But as of now, the bias is it's likely going to be a red January. Are you ready to dive in the charts? You better be. Here's a snippet of yesterday's analysis. Timeframes and be more nimble. If I see not even a closure is needed, if price simply gets below there, even there was 50,850 for a minute. I'm not going to be bullish anymore because the week just flipped red after a rejection of the 21. Is that making sense of why and the logic behind it? Now let's see if this line that I just drew in, let's see if it aligns with anything else. Well, it roughly aligns with this whole structure's high. So if price breaks back below there and the weekly momentum does indeed turn red, well, then you're probably going to test the middle of this structure back down at around 48K. Back down around 48K. So remember, the importance of this was that the week prior here that just closed, so this week is only 2 days old. I was making that analysis when this candle was green. And I said, if this flips red, which was what that blue line was, the blue line was exactly at the top of this candle. So at the time candle was green up here, it was green. And I said, if it flips red, you don't even need a 4-hour closure or 1-hour closure. If it flips red, it's probably going down in that moment, right? You just heard me say that. I mean, it's just such stupid, simple analysis. But the reason, so here's the key. Here's why this is so important to soak in and review. Remember this for next time. The only reason I was so confident with that trigger is because the week before got rejected by the weekly 21 EMA, which is the yellow line I've drawn in here. It's that simple. So I have drawn in the weekly 21 EMA. Here is that rejection from the week prior right here. But then we zoomed in on the 1-hour chart. We zoomed in, take off the EMAs, and we saw that it had a lot of trouble getting above. And my 50,850 line I drew right here. I said, even if it just dips down there a tiny bit, it's going to hit 48K. And where is it now? Just under 48K. It went right to my line, right? It just went straight to it. And with extreme acceleration right at that line. And it's all because of what happened here at the rejection from the last week. Even though we're on the hourly, all of this activity on the hourly was that wick above and then it closed below. That's what you're seeing here. And so I had drawn that line almost exactly right here. And I said, if it goes below even for a minute, it's going to come down and hit 48K, which is this line right here. So now Bitcoin has done something that it likes to do a lot on a lot of different time frames. It worked its way out of a descending channel and broke into a horizontal channel. So now let's zoom out and see what it's in now. Like this. So Bitcoin was in this descending channel. You look how big this channel was. Very, very big channel, right? See that big channel? And then it worked its way out of it. And now it's in a trading range right here. So it's essentially now in a trading range box. And I said that 48K is roughly in the middle of this. So I anticipated with that, because it's the middle, I anticipated that it would simply fall back into this box and hit the middle of it. And that's exactly where we find ourselves now. And that's the importance of interpreting the weekly candles. I know that a lot of you who watch my channel, you hear me say a lot, start with the weekly in mind, right? Particularly on Sundays and Mondays. And yesterday was Monday. So hopefully my quick review at the beginning of this video shows you the importance of that. Whenever even if you're trading the 1 minute or 3 minute time frames because you're a crackhead taking profits in and out of trades, every hour, that's fine. But you need to start with the weekly in mind. So next, what I'm going to do is I'm going to go over the premise of the trigger that I'll give you next, but I want to give you the backstory of why this trigger is so important. Before we do, make sure you take your phone and you flip it. Flip your phones or get flipped off now. kindly hit that like button.
It's especially important for all you returning viewers.
Leave a comment down below or you'll get a foot of snow. Just leave me a written comment down below to help the algo. Here's what will help you. If you make sure the bell is hit, because this is time-sensitive information and I can't deliver it to you in a time-sensitive fashion if the bell is not hit. Smash that bell. We're in this together. Now we're going to dive into the charts and I'm going to give you another super simple idea that you can use so you can know when you can flip your biases. Follow me on Twitter at 𝘃𝐢𝐬𝐻𝑡wo. Turn on your microphone and camera and ask me questions directly and live. Links to the Discord community in the description section. If online communities are not your thing, but you still want exclusive content that you can't find anywhere else, go ahead and hit the join button below this video to have a video pop up that shows you what my YouTube tiers offer. I'm going to Lord of the Rings this 𝐵𝑠 because this is the one line to rule them all. And honestly, I'm not just playing around. It really is. This is the weekly 21 EMA. I'm going to do a quick exercise to show you why the trigger I'm about to show you is the trigger. So let's go back in time to the previous bull run of 2016 and 2017. Do you see any candle closures below this yellow line? Not one. During the previous bear market, where did all the candles live? Below the line. How many closures did you have above? 1, 2, 3, 4. You had 4 closures out of 61. See down here it says 61. You had 61 bars, only 4 closed above. Bull market above, bear market below. The one line to rule them all. So roughly from this point when the bull market of 2012 to 2013 took off, do you see any weekly closures below? No, you don't. Do you see any weekly closures below? You had 1. Let's zoom in. Look at that. You had 1 closure because the next candle right here closed above. Actually, technically you did have a second one. This squeaked out a second one. So you had 2 candle closures and then it quickly recovered and got on top. And the next time it went below, what happened? The bulls took it right back above. Now let's fast forward to the bear market. You had 1 very strong dead cat bounce, but with that exception, from this point, all candles were below.
Open your eyes and see the master line.
So very simply put, there's really no reason to be bullish until a week closes above this line. But how do we guard ourselves from a dead cat bounce or a fake out? Well, it's actually pretty simple. Let's dive in and I'll show you a simple trick, and it has to do with the candle structures. It's super simple. So now we know we're looking for a weekly closure above that yellow line, and the yellow line does move. So if price keeps going down, and by the time it gets above, the yellow line might be down here, especially if the greater range, let's zoom out and see the potential for 30K. As much as it pains me to say this, we are in this range and just got a rejection from the top. So typically you test the middle, which technically was done, particularly on CMEs. This box technically was checked. So as long as Bitcoin can bounce around on this box above 41K, there is a chance to come right back up here. You see this? This would be March. And because price is below the yellow line, it's not getting above, you can interpret that there is definite potential for hitting the downside target of this. It is completely possible as long as you're below the yellow line. So here's how to guard yourself from a fake out closure above the yellow line. I only got 2 simple rules. Both can happen at the same time. One can happen without the other, but you only need one in order to trigger your reverse bias back down to the downside to guard yourself. Rule number 1, if you get a closure above, if the next candle closes just a tiny bit below, then you are no longer bullish anymore. So you can see here, this was an emotional roller coaster. Reason to be bullish, reason to be bearish, reason to be bullish, reason to be bearish. This was very hard to trade because if you were trading lower time frames, well, you were trying to trade bearish and then boom, you got a weekly candle that was green. And then you could have flipped your biases back at the beginning of this candle once it got above the yellow line, which is the weekly 21. So that's rule number 1. If you get a candle closure below and any candle in the future closes back below, you flip your bias back to bearish. Rule number 2, if you get above this line with the preceding candles, if any one candle goes below the bottom candle body of the previous candle, even if you're still above this yellow line, it doesn't matter. So for example, in this case right here, at the exact moment that this candle got below, even for 1 second below the bottom of this candle, you now flip your bullish back to bearish, even though at that exact moment you were still above the yellow line. It doesn't matter. You can't be bullish in that case because when you look at all the times that you got continuation, price did not go back below the previous bottom of the candle. It just really doesn't happen. So that second rule would have been a really nice thing to know at this point in time because you could have flipped your bias to the downside and really gotten some nice trades out of that. So now with these 2 rules, let's go play around with previous prices to see how that would have worked out. So let's go to 2013. You had your first candle closure below, the next one closed above. You have a slight bullish bias at the closure of this candle. The next candle closed down, you turn into an emotional roller coaster because now your bias is a little bearish. The next one closed above, your bias flipped yet again to being mildly bullish. The next candle here, still bullish because you didn't close below the line. The next candle here, there was a quick moment in time where price did go below the open of here, but once it got back above, you would have flipped bearish, then bullish. Even though this is a red candle, it doesn't matter. It went below the bottom of this candle for a hot minute. For that hot minute, you would have been slightly bearish, but you were still above the yellow line, so you wouldn't have been full on bearish, taking on monster shorts. But you would have been mildly bearish for the day or few hours that it was below. And then when it got back above, particularly at this closure, you still would have been bullish with this red candle. That's a bullish closure because it closed above the previous candle's open or bottom of its body. So at this closure, you would have been trading bullish. Would that have served you well? Absolutely. So this right here also was a slight emotional roller coaster, and it lasted 42 days until it was just bullish to the upside. And trust me, those 42 days probably felt like an eternity for people who were staring at the charts. We are in 2014 entering the bear market, but at this point, no one knew that they were entering a bear market. You had a closure below, so you have a bearish bias. Closure above, you have a bullish bias. You had a closure above. Even though this candle was red, I personally would have had a mildly bullish bias for the next week. But here's the thing, even though that bias is wrong, here's the rule number 2. At the exact moment that this candle went below this candle's body, you then flip back bearish, and that would have served you well at the exact moment it crossed that line. And then you could flip down to more shorting or 3S tokens or whatever you're into. This is rule number 2. Rule number 1 was you flip bearish at a closure below, but rule number 2 activated first. So therefore you would have been bearish at the very beginning of this move down. Same bear market of 2014, first dead cat bounce. Let's see how this rule 1 and 2 would have played out. Closure above, bullish bias. During this wick down, it stayed above the yellow line and did not go below the previous candle, so you still have a bullish bias this whole time, which would have served you well for the next week. This candle never went below this candle's opening. You still have a bullish bias. This candle at its open, you would have had a bullish bias until when? Until price, even for 1 second, went below this candle line, you would have had a bearish bias trading to the downside. For the rest of this week of this candle here, you would have had a bearish bias, but at the closure, because the closure was above this line, you wouldn't have been totally bearish, but definitely leaning a little bit bearish because this candle closed below the previous candle. Bitcoin became a stable coin for 14 days. You had 2 closures above the yellow line with a nice wick and buy pressure to the upside. I personally would have seen this wick and traded very cautiously to the upside, taking profits regularly and not looking for some month-long swing trade at that time. So that would have served me well during this candle. This candle here, it never went below, not even for a second. Let's zoom in. This candle here never went below at any moment in time the previous candle, which is rule number 2. So this whole time, I would have been very, very cautiously bullish on the lower time frames only. At this candle, the very beginning of the week, it went below the previous candle's lowest end of the body. Therefore, my bias in that exact instant at the very beginning of the week would have been bearish because even though you're still above the yellow line, which is rule number 1, it doesn't matter. One rule without the other, it still is the trigger. At the exact moment it went below this candle, I am now bearish, which would have served me well. So this whole time I would have been trading to the downside. Even for this green week here, it did have several moments of time where this wick went below the previous candle's body. So therefore I am still bearish regardless of this green candle. It went below the bottom of this one. That's rule number 2. Did that serve me well? Abso-freaking-lutely. Look at that. That's when the capitulation happened. And that's why, even though I'm primarily an EMA type of trader, candlestick formations are still something that I consider a primary indicator because it helps supplement my expectations of the very next week so I can better interpret what the EMAs are doing. So let's go to this little ditty right here. At this candle closure right here, I would have been mildly and cautiously bullish. Served me well the entire next week. At the very beginning of this candle, it went below the structure of the previous candle. So this right here went below this candle. So even before this candle right here went below the yellow line, which is rule number 1, it doesn't matter. Rule number 2 was activated because this candle went below the previous candle's body structure. So I was bearish before the yellow line was hit, and that would have served me exceptionally well. So now we're at current price, and now with all those reiterations, you can imagine all the probabilities and weird crap that can happen as candles start closing above here. A lot of weird stuff can happen. There's no way to know exactly what it will be, so the best you can do is know when to flip the way that you're trading and to flip your expectations. And so these are the 2 triggers that you can use for when that moment finally comes. But until that comes, you probably shouldn't be leaning too bullish. Because remember, I just showed you that macro range, and Bitcoin could easily test the bottom of it down to 30K. And if you go back to my recent video with the word candles in it on the thumbnail, I showed you why the candle closures of the 3-month chart and the 1-month chart are looking really bad at Bitcoin on New Year's moment. When you say Happy New Year, if it's below 52K, we're probably going to have a red January. So then you have 2 different reasons to not be bullish. 1, you're below the yellow line, the line to rule them all. Number 2, the monthly and the quarterly candles are giving bearish signs. So given that it looks like Bitcoin's going to close this month on Happy New Year below 50K, I'm probably going to at least start January with bearish expectations. Watch this video right here if you want to review the video about the monthly and the quarter closing candle shapes. Click this video right here if you want to learn how to set up a chart just like mine, which will allow you to understand other price analysts like myself. It'll be so worth the time. And if you're new to my channel, click the circle right here in the middle to subscribe. You just got Timified worldwide. Peace.